Hello, and welcome to Let's Talk Tax, the show for growth-minded CPAs and real estate pros in tax. I'm TJ Sponsel. In today's episode, we will discuss IC DISC and the incentives they present. Joining us today on Let's Talk Tax is Jerry Hammel. Jerry is a shareholder at McGuire Sponsel, specializing in international tax and strategic tax planning. Welcome, Jerry.
I'm glad to be here, TJ. Thank you.
Can't believe it's our first time doing this together.
I can't either.
We've been doing this so long, 20 years together. They're just now letting us do an LTT podcast together.
Well, they tend to keep us separated.
Seriously, nothing can go wrong in today's episode.
Absolutely nothing.
So a quick background for our listeners, and thank you for joining us today, is that our IC DISC practice actually started over 12 years ago. It was a conversation Jerry and I were having. Jerry at the time was a director of tax for a top 60 CPA firm based here in the Midwest, and we were just talking about how can we find additional services to serve clients. And one of the conversations was there's nobody that was really doing IC DISC the way McGuire Sponsel at the time was doing R&D and cost segregation. And so we kind of rolled up our sleeves and really developed this. Jerry's firm and McGuire Sponsel developed our IC DISC practice kind of together.
Yeah.
Obviously, McGuire Sponsel serving our clients, your former firm serving their clients. And we just have been very, very fortunate, some great success, a couple hundred companies that we serve annually with this area of tax law. But today's episode, Jerry, I really wanted to kind of deal with some of the myths associated with IC DISC.
Okay.
Because I think sometimes it's an overlooked area of tax law, frankly.
It is, TJ, and especially since the QBI deduction came into play. So that arbitrage, as we'll get into later, the true benefit of the DISC, since that narrowed so much, back in 2018, it hasn't been as popular. And so I do think it's often overlooked.
Absolutely. And I think some of the calculation options that are available for people that have been doing DISC a long time, they've been taking maybe that low-hanging fruit, that safe harbor, 4% of export sales, and not really diving into looking at the detail. You mentioned the tax arbitrage. When we started doing this 12 years ago, it was a 20% arbitrage.
Right. It was a
easy.
no-brainer.
It was easy.
Yeah.
The most intimidating thing to do was because it's a prospective tax strategy, is that people to speculate on what their revenue, their sales were going to be for the following year. It's not like any other things we do where we can go back and amend, post-date the agreements. Now it's everything. It's prospective. So
right.
So with that, I think let's dive into a little bit of the calculation options for companies that haven't understood that. They go, okay, what's this really mean? We talk tax arbitrage and T by T and safe harbor. Let's kind of jump right into that and say, okay, what is the overall opportunity for an IC DISC?
Let's back up just a second. Instead of getting into maybe the detailed calculations, but what is that true benefit? And we say tax arbitrage. Why is that important?
Sure.
So let's say you've got a manufacturer that's got, we'll just use $1 million of exports. Simple number, simple math. Basically what you're doing is on those export transactions, you're going to calculate a net income called combined taxable income on those export sales. And off of that, you're either going to look at 4% of that $1 million revenue, or you're going to take 50% of that CTI, that combined taxable income on their exports, to come up with that commission. That's the basic premise of how you calculate it. Now, what the benefit is if you have as you said, it has to be a prospective benefit. So you're going to form a DISC entity. You're going to make an election so that the DISC entity is a tax-exempt entity, and so it doesn't pay income tax. Typically, with a flow-through entity, you're going to have that structured so the flow-through entity owns 100% of it. So in my example, we calculate on $1 million of exports, let's say we calculate a $400,000 commission. The operating company, which is either an S-corp or a partnership in this example, would take that deduction against ordinary income of $400,000. The DISC would receive that commission income, and then it would dividend it back up to its shareholder, the operating company. And so you effectively took $400,000 and converted it from ordinary income to qualified dividend. Why is that important? Well, in 2003, when they changed the taxation of qualified dividends so they'd be taxed at the long-term capital gain tax rate, that allowed for that arbitrage to come into play. So in that simple example, you'd save about 5.8%, it'd be 6%, we'll say, on the $400,000.
And that's really, I think, one thing that I always hear, and people talk about IC DISC, they're almost fixated on what's my sales? What are my sales? And what I try to explain to them is that it's not a sales deal. It's not a revenue deal. It's a profit deal.
Right.
Because you can have clients, if you look at some of the literature, it says you have to have $1 million of revenue. You have to have $2 million of revenue to make sense, which in some cases that's correct. But if you have a company that's a high margin company, it doesn't have to be $1 million or $2 million, because you're really the ultimate, the net income on those exports is what drives that commission dollar.
It is, and that's where the true secret sauce is. I mean, so you come in, you got $2-3 million in exports. Well, what's your profitability, right? Are you a low margin, high volume producer, or do you have some creative products where you command a higher margin, or they're unique products? And if that's the case, then you could probably justify the investment to have a disc strategy in place with lower export sales.
So now we know kind of what that benefit is. About a 6% of the commission. The commission's based off net income. So kind of working backwards a little bit here. So 6% of the commission's driven by income, not sales.
Right.
Now let's talk about what is a qualified export, because there's some opportunities there as well. And I think there's a lot of myths associated, because you can have direct exports and indirect qualified export.
It also is it are U.S. companies that benefit from this. So there's a content requirement. So over the 50% of the value of the content of the product being sold needs to be produced in the United States of America. So that's that first step.
Does that mean like IP when you say 50% of the value? So if I'm designing something, that's IP is also part of the content, the value of the content, correct?
Absolutely.
Okay.
Yeah. And so let's assume that it qualifies from that standpoint in terms of the source, being produced in the U.S. Then as you said, the easy ones are direct exports. So they have customers outside of the United States. Those are obviously export sales. What a lot of people miss are the indirect sales. And as long as your product is identifiable after it's sold to somebody in the U.S., but they manufacture or they do something to it further, as long as your product's still identifiable, they would then in turn export their product. You can count that as what we call an indirect export sale.
Okay. And that's what I've always found with our clients that rely on indirect. It is a little challenging because we have to get verification. They're going to have to rely on our client has to rely on their customer to verify where that product's being shipped.
Sure. And some customers are uncomfortable doing that. A lot of times what we've done on the indirect sales is we'll get a memo from their customer, that just says, okay, this product model A, 40% are exported outside the U.S. It can be as simple as that.
And I say this because this has actually come up multiple times in meetings, because I think so many people think of NAFTA, that NAFTA provides some kind of block on a qualified export into Mexico or into Canada.
No.
But Mexico and Canada are foreign countries.
Yeah, believe it or not, they are not the United States.
True story. It came up in a CPE one time I was getting in. One of the CPAs raised their hand. They go, this doesn't count. It goes to Mexico. And we were like, Mexico is a foreign country.
And it's so funny because, if you're shipping it over the Atlantic or the Pacific, obviously, that's an export.
Yeah.
But then it's just being shipped across the border, but it's a landmass. People tend to forget Canada and Mexico.
But what's important about Mexico, and obviously with the way the U.S. works, we ship product to Mexico, it gets manufactured and gets shipped back to the U.S. for consumption or for sale. That situation wouldn't qualify, correct?
It would not qualify, no.
Because the product has to be stay for a 1 year period, I think.
Yeah, it's a 1 year period, yeah.
Okay, and I think that's what also trips up some people, because they think, I'm manufacturing this component that goes into a Trane air conditioner that gets manufactured in Mexico, comes back and sold at Home Depot or whatever else.
Right.
That would not be qualified.
Correct.
Okay. I think one of the things when we look at discs is that, as I said earlier, is a little intimidating, because clients look at this and go, I've never done this before. I've got to speculate on my sales. And this sounds like a very intimidating structure for somebody that's never, when you talk about flow throughs, and it's kind of a circular event if you think about it. And sometimes I know some of our illustrations are literally diagrams, circular diagrams. Kind of walk us through in terms of what some of the compliance requirements for a disc, because it sounds complicated to start. We obviously try to simplify that as much as possible, but there's some definite triggers that a company has to follow throughout the year to be able to maintain their disc status.
So let's just pretend you're a client. You come to me. We do the evaluation. You're sold. You say, hey, disc makes sense. Okay. So we get engaged. First thing you do is we'll incorporate the disc. We'll draft all the agreements between the owners and the entity. We'll get your EIN number. All of our discs are commission discs, meaning that the disc doesn't actually take title to the property. So this is basically a papered agreement called a supplier agreement between the supplier entity and the disc. So we get that executed. We draft that for you. And then basically the final thing is we make a disc election. Really, really critical. because that election allows the DISC to be not subject to tax. You miss the election, that DISC is now just a C Corp. So you got a problem. You got another layer of tax. So that's really critical. So we get the DISC in place, and again, as you stated earlier, that's important because I can only count for the commission benefit exports that occur after the DISC is in place. So it's really critical to get that DISC in place as soon as possible.
Now, real quick on that. That is when it's shipped out of the facility, so a factory. It's not the purchase order.
Correct.
So if I have a purchase order and I've not shipped it to Brazil yet, as long as I get that DISC set up before it gets shipped to Brazil, I'm okay.
That's correct. Yep, because it's still sitting in inventory. It's not a sale yet.
Okay.
Yep, great point. So then the next thing, what do we do? Let's assume it's a calendar year-end taxpayer. We got the DISC set up properly January of this current year. Now we're rolling through the year. Now we're in January the following year. What do we do? Well, you have 60 days roughly to calculate a preliminary commission and get that funded. Okay, so we'll get preliminary information from you. Nobody's got their tax return done yet. Probably have a rough draft of the year-end financial, and we use that information along with the detailed export transactions to calculate the commission. And then we have the client pay what's called a preliminary commission. So they get that paid within 60 days of the close of their tax year. Now they're waiting on their accountants. We get the financial statements finalized. You get the tax return finalized. Once that's done, then they'll get back to us and give us like the trued up taxable income, the final taxable income. We'll rerun our commission calculation to true it up to the final taxable income. And then if there's any true up payment back or forth from that, that'll be made. And then really the final thing after that is just getting the tax return filed, which is due September 15th. It's due in the 15th day of the 9th month because a DISC could have a year end other than a 12/31.
Okay.
Yeah.
So we talk about making payments, and obviously we've been doing this a while.
Yeah.
There are some people that just trade notes. They don't move cash. They do notes. Can we touch on that? Because I think that's a little bit also a slippery slope.
Yeah, it is, and I think so. Look, it's really hard to argue. Have the IRS come in and argue that maybe the commission wasn't paid if it's paid in cash. Okay, so number one, get the cash payments made. We even have some DISC clients that don't wait until after 60 days after the year end. They'll just make some quarterly payments into the DISC and send them back up or accumulate the cash there, for that year. But others will. You're allowed to do notes. You are allowed to do that per the code. But I think then you run the risk of, okay, is it a valid enforceable agreement? Does it meet the statutory requirements of a note? Was it executed within the 60 days, and do you have proof of that? You're just inviting other issues. So we prefer just seeing cash change hands and cash go in and out of the bank accounts.
Okay. Something else I think there's a distinction that you touched on earlier, and I want to elaborate a little bit more on, is that obviously a DISC is a tax-exempt C Corp. Okay. Well, but a C Corp entity, so if Sponsel Manufacturing was a C Corp, the C Corp could not own the IC DISC. If I was an LLC or a partnership, the Sponsel Manufacturing could own that.
I would clarify with it. It could, but it really doesn't make a lot of sense.
Make sense, yeah.
Right? Because again, we're trying to get after a tax arbitrage. Really, in the C Corp world, a C Corp can own a DISC, but typically the structure there is that you're setting it up separately. And so that maybe it's owned by the same individuals that own the C Corp, and then that commission gets paid out. It doesn't come back in the C Corp.
And that's the difference I was I wanted to elaborate on, because I think with a C Corporation, if the owner, the individuals own the IC DISC entity, that cash actually leaves the operating entity.
It does.
Compared to an S Corp or an LLC owning an IC DISC, the cash really doesn't leave the entity. All you're doing is ultimately, I think a lot of our clients, they're just reducing their tax distribution and keeping that money in working capital.
Honestly, TJ, with a flow-through entity that owns 100% of the DISC, it's really shifting it from the ordinary income line down to the qualified dividend line. It's that simple. Doesn't impact their net working capital. Doesn't impact the cash that remains in the corporation at all.
Sure.
In the flow-through. Now, the C Corporation, we do have more conversations with those clients because what are their banking requirements? How much equity they want to maintain in the company, because that cash is not coming back in.
Staying on the C Corp topic with an IC DISC, we've actually seen situations in which, because the distribution, it's not taxed until the distribution is paid out.
Correct.
So we've seen situations where you have a C Corp entity pays the DISC out to another entity, but they've not ever paid out those those commissions out to the shareholders.
Yeah,
so it's trapped. You have money trapped in the IC disc that creates a lot of problems for companies.
Well, it's trapped in the disc, but it's also and not to get, this isn't a technical seminar or anything, but IC disc is interest charge domestic international sales corp. So the IC part is interest charge. These disc were originally established back in the 70s. And what it was a deferral of tax up to $10 million of revenue. So what you had to do, though, to get that deferral was you had to pay an interest charge on the amount of tax liability that had been deferred. So that's where the name comes from. So in that example where the C Corp's paying the commission over the disc and they've accumulated the cash, maybe haven't paid the distributions out to the shareholders, well, on their Schedule K, the individual owners, they will get will report a deferral amount, and they're supposed to put that on their tax return, calculate the tax liability associated with that, and actually pay in an interest amount that's in the form of additional tax on their 1040.
Going back to our example that we were using earlier of let's say I have a company that ships occasionally outside the country, okay? Or my exports aren't consistent. What happens in that situation? You have 1 year where you have a disc commission, the next year you don't. Maybe a couple years down the road you see some. How do we handle those situations? There's a lot of
volatility,
up and down, volatility. Yes.
Yeah. Or seasonality or whatever you want to call that. So a lot of times what will happen is, there's a cost to set up the disc initially, correct? And so if it's going to be something that's just variable over time, but you're always going to have some exports at some point in time, then what we recommend is that you keep the disc in place. You don't want to dissolve it because you're not going to have any exports the next year and then have to reincorporate it the year later. That just wouldn't make economic sense. So typically we keep the disc in place. You don't have to claim a commission for that year. We can do what's called claim a zero commission, file a zero return for the disc to keep it in good standing, and then you just move on to the next tax year. Okay. Yeah, it's pretty simple.
Obviously, you mentioned QBI, which is kind of obviously squelched a lot of some of the savings of a disc. But obviously, with TCJA expiring, in 2025, obviously I know Republicans in Congress have already set up some subcommittees to look at. What do you think that means for the disc going forward?
Well, I think so. Okay, good tax answer. It depends, right? So here's what I would say: if the two parties can get together and they can figure out what they're going to do with the various provisions of TCJA that are set to expire, if QBI gets extended, then we'll be right back. We'll be right in the same position we're in now, where you got that 5.8% arbitrage. If it expires, which it's set to do at the end of 2025, that arbitrage goes to about 12.8%. So when I look at that's going to make those exports that are those prospective clients that have an amount of exports that they might be right on the bubble as to whether it makes sense. All of a sudden, they'll probably make a lot of sense, to establish the disc and implement that strategy.
What is, let's talk about the different calculation options one more time, because I think that's something that we see in looking at a client that has a disc formed and they've come to McGuire Sponsel or they've switched to CPA firms that they use us. What do we see the difference of looking at that safe harbor 4% of export sales to T by T, transaction by transaction? There's a pretty good delta there typically, isn't there? When you're looking at 4% to T by T?
There can be a really large delta. What I would say first of all is that disc seems simple. Okay, so I think a lot of people think they can just jump in and do that. And when we do pick up we work with a CPA firm that's picked up a new client. They'll say, hey, can you help with the disc? And we'll look at the disc return. And you're absolutely right. Usually what they'll do is they'll just take that $1 million of exports compared to the domestic, do some simple allocation of cost of goods sold and SG&A, and come up with an income number, and then simply just take 4% of that revenue or 50% of that net income on the exports. Just a very, what I call a global look at their exports. That's certainly one way, and you can do that, but you're leaving a lot of money on the table if you do that. The other alternative is if that supplier company has really good record keeping and data in their GL where they can export their domestic and export transactions, then what we can do is a transaction by transaction analysis and look at every transaction the company had for the year for domestic and exports. Now you might ask me, why do we look at domestic? Well, when you do T by T, you can really break it down about any way that you want to. And what I mean by that is you can look at each individual transaction, You can go back and look at just the global export product, or you can go ahead and then you can look at, okay, I understand your product lines. You have these families of products, and then within those families, you have these product categories. We can really take and group them into product categories across those families. If they're similar products, we can go by just the whole family type and aggregate them. And the reason you would do that is you may have some product lines that have a lower margin, and these have a higher margin. And when you go in and you start grouping these and evaluating these, it's a bit of a chess match. It's a puzzle. And when you look at these, you can throw out maybe you have a group of products that have loss. It's a loss leader. You can throw those out. If what's causing them to have a loss is the SG&A, you can use what's called marginal costing, which only looks at your labor and your material cost and your labor, and then what it looks at then, TJ. And I know it sounds crazy, but it then looks at what the overall profit percentage is for the company or that product family, and you can pretend, if they have positive marginal cost margin, you can pretend that they made, if your overall profit percentage is 15%, they made 15% on those transactions. So there's a lot of planning opportunities, but it really, the devil's in the details. If you can get the detailed information, then you can sit down and figure this out, and you can try to maximize that discommission. So circling back to your question, yes, rarely have I seen a T by T analysis that was equal to or less than that global look. It's typically always better, and it's just a question of how much.
For those listening today that maybe have always just done that 4%, and now they go, wait, I didn't realize a T by T was that much greater. Is there an opportunity to amend disc returns to go back and capture those additional savings?
You can amend, yeah. There's circumstances where we have amended disc returns, yeah.
And so the ability to moving the money by the end of the fiscal year, that's all. We're not going to violate any of that by amending returns.
No. You would probably have to. You're going to end up probably having a deferral and having to pay some interest charge, on part of that deferral. But then you would get that cash. Eventually, you'd get that cash down into the disc.
Okay.
Yeah.
Well, Jerry, thank you for joining us today.
No, glad to be here. So it's a lot of fun.
All right. Thanks for tuning in today. Remember to subscribe to Let's Talk Tax podcast channel on YouTube to be notified and receive all new episodes.